guys ready? Okay, we're gonna go down and dirty. So forgive me because this will be a bit of mortgage banking background. So we're gonna kind of like unveil what we see as mortgage bankers. I've been doing this for 16 years. Mike, you've been plus 20. Okay, so we've seen a thing or three. What we're gonna do is basically just go over budgeting and financing. So we're gonna be looking at from the bank's point of view, okay? But we're gonna start from the cash perspective first, and then we're gonna gradually move our way up to the type of programs that are available for renovation or for additions onto properties. Is that fair? Okay, so the first thing is benefits of financing and adding a property to your current residence. Now, there's a difference between cost versus value. One of the things that may differ from your point of view versus the bank's point of view is what the property's current value is based on the appraisals. And these guys over here at South Shore will be able to answer questions on appraisals. But it may differ from the bank's point of view. Some of the things that we're going to look at is going to be either the future value on the property after completion, as well as the rental cash flow, okay? So it may vary property to property. And the design and usability of that property. So just because you add a unit on, the bank needs to see that as well, and usually it does an improvement, okay? Let's start with cash, because we have this question asked often. So, pros of cash, ease of use, okay? That's pretty much it. Cons, ease of use. I'll explain. So, due diligence is really, really important in the part of the process when you're going to be building an ADU. So, costs associated to the transaction. One of the things from the bank standpoint is that should you start doing a build for some reason and you run out of cash, you will not have a break in construction. Okay? That may be a problem. You won't be able to traditionally finance out of that property because you have some wall taken down or a section of your roof or this thing in the back of the yard that's not completed. All right? The other thing is going to be depletion of reserves. So many times people will chase after that build and run out of money in the process. The bank will look at you and be like, I want to lend you money. Right? All right. The next risk that we see often is being taken advantage of. And unfortunately, when we do see some of the quotes or bids come in, it may be X amount of scope of work, but as the project's completed, people start adding in other marble countertops or, the Versailles tile, things like that. So that does happen. The other type of financing that's available is what's called a line of credit. So a line of credit basically is a second mortgage that gets added onto a property. And now in the second mortgage, typically the loan amounts are not very big. The cost of it's very inexpensive. It's interest only, okay, so your balance does not go down as you make payments. And you only pay on what you draw. Just think of it like a really big credit card, okay? Now, again, ease of use, because if that line of credit does run out, you may run into a problem. The cons. This is where we're gonna get a little technical. So normally, lines of credits are limited to about 80, 85, 90, and 95% loan to value. All of you are financial fingerprints, okay? So depending on your qualifications, you may be limited to the existing loan to value. FICO scores are also a factor, okay? So between whether 680, 700, 720s, financial fingerprints. The line of credit that you pull may be too small. Line of credits can be frozen by the bank at any time. So if market conditions change, property values change, that value, that $100,000 line can be cut, okay? You may be ineligible for future financing because a line of credit is considered a cash out. All right, so these things need to be really taken into consideration. The interest rates are controlled by the Fed. Recently, we've all heard last Wednesday that the Fed cut the prime rate by 0.5%. So if you're tied to the prime rate by the Fed, which is a home equity line is tied to, that would bring your payment down a bit. It also goes the opposite direction. So if rates do get raised by the Fed, so does your equity line. What else? May fall short of funds, went over that. and typically owner-occupied homes. Fair? So when is it a good option? When you have great credit and tons of equity. Second option. Third option, it's going to be cash out refinance. So cash out refinance, some of the pros on a cash out refinance is obviously one payment. You just wrap it into one loan, take the money out, you have one payment. Possibility right now with rates being as low as they are, you can take the cash out as well as lower your rate at the same time, as well as paying off other bills and credit card debts along the way. Have a few of those. Now, as long as the loan to value, the existing loan to value does not go above 80%, when you take that money out, you won't have mortgage insurance. But should you need to take a whole bunch of money out and push that loan to value really high, not only will you have your mortgage payment, but you will also have mortgage insurance added to that payment. That needs to be taken into consideration for your budget. Another thing that's possible is where you can piggyback a first mortgage, take money out, and add an equity line of credit. Okay? Cons. Now, I mentioned you are limited to loan to value. So it's really important that we know the amount of money that you're taking out is going to cover for your project. You could run out of funds, all right? You may take a higher interest rate. So if you recently refinanced and you took advantage of the lower rate, now having to pull money out can affect your interest rate. So something to take into consideration. Another thing is the cost associated with a new loan, all right? Because that's going to take a chunk of the equity as you pull some cash out. If the construction has started already, or it's already in need of repairs, and the property may not be eligible. So we see that a lot of times where somebody had started a remodel in the kitchen, everything's been torn out. And we can't send the appraiser back out because the house is not functional, okay? So it's really important that we don't have a break in construction, that you sit down with a qualified lender in advance so they actually understand where you're at in the process. Very, very important. You must credit qualify. So a lot of times people want to do something like this and they may not have necessarily the income, or they're transitioning jobs or have a new baby. Something may be different in their life, but it's important for us to sit down with that. Some loans that don't have to qualify with income but do credit qualify would be like a reverse mortgage. So there's ways that we can actually take money out without income, but because of your age and the type of program, money could be pulled out to create that rental cash flowing unit. When is it a good option? Typically, in the current property value, you happen to have enough equity. Okay? Make sense? Am I going too fast for you guys? Okay. Now let's go over renovation loans. So renovation loans, pros. This is one of the things that's pretty awesome on a renovation loan. It's based on the future value. So if you wanted to fix up your house, add a bedroom or a bathroom, and add an ADU onto your property, we're going to be using the future value in the assessment. Okay? We can convert that to cover all the cost of renovation as well as the soft costs in the transaction. So in a renovation loan, paying for permits, architect fees, structural engineer, and so on, that can all be wrapped into the loan balance as well. It's possible to also finance up to 6 months of the payments. So if you're doing an addition in your home, you're adding the ADU adjacent to the existing structure, and you can't occupy the subject property while you're in construction, you can go rent someplace temporarily and finance up to 6 months of the payments into the loan balance. Okay? Great feature. We don't, as the bank, don't want to see you have to pay 2 housing payments at the same time. Make sense? A HUD consultant. So one of the things as far as the process is the bank wants to make sure that you're protected as well as the bank, okay? So while you're taking draws on your property, you're gonna be assigned a HUD consultant. The HUD consultant's actually gonna be walking you through the phase of the process with your contractor to make sure the construction of the job is completed to the satisfaction, as well as the time frame and meeting your budget. Every phase line of construction, that HUD consultant comes back out, verifies that the work's been done, everybody agrees, money gets released. So the HUD consultant actually will be a step in each part of the process to make sure that everything is tracking. The next thing that's really difficult to really dial in, but very important to, is going to be a detailed itemization of the scope of work for your property. So, what does that mean? It means you can't have draft plans on a napkin. Okay? We've seen it. Trust me. Am I wrong? We've seen it. It means not having the scope of work written out in a paragraph. We need to see everything itemized out in your project, which dually benefits the homeowner. How much are you paying for that construction slab or the tear down of an existing property or the walls, the flooring, the plumbing? What kind of appliances are you putting in there? All those things itemized in the scope of work in detail, because that's what we're going to need. When we get that from our standpoint, it gets reviewed by the HUD consultant as well as the appraiser to know how to value your future value. Okay? So one of the things about working through the bank standpoint, even though it's a little bureaucratic, there's certain steps in the process that actually protects the homeowner and protects the bank at the same time. Make sense? Okay. Ooh. The fund control draw account. So here's something that's actually a benefit through the process. Basically, when we pay off your existing first mortgage, you're going to have a chunk of money set aside into a trust account. That money's sitting there for you in protection. The contractor, when they do the work and they complete it, that's when they release money, not before. Okay? So that money being sitting in a trust account is really important because it protects your asset. If that contractor you need to fire along the way, you can, and you still have the remaining money sitting in that account. Make sense? Okay. The only thing they will draw up front is maybe, 50% of the cost of materials. So if they have to order lumber and things like that, they can order 50% in advance, but it comes out of that account and it's accounted for. They also do lien releases at each phase. So basically they're stating, you don't owe me anything, I don't owe you anything, there's no liens going from this point forward, let's continue on. Make sense? On the renovation loan as well, you can actually do this with a purchase or a refinance. Purchase is a little sticky. Time frame is very particular because it does take a lot of machinery in the back end to put something like this together. Okay? In the process of a renovation loan, you can also do other things to your property as well. So I have a transaction where they're adding a master bedroom and a master bathroom, as well as building an ADU. Okay? Unique features. So I went over this earlier. You can have up to 6 months of the mortgage payment added into your loan balance, number one. A 203K loan can go as far as 110% of the future value. Okay? So even if you're going to overbuild for your neighborhood, you can still have a 10% buffer above and beyond. One other thing I didn't mention in this is that in the money we set aside, we also set aside 10% for cost overrun. You never know if that contractor may pickaxe a sewer line, cut a pipe, something like that, and unforeseen circumstances you need to get paid for, okay? And we went over the fund draws as they go. The true cost of your transaction. So everything before you close your loan has been laid out in front of you. You have all your scope of work, all your detailed cost, itemized bids, everything before you sign on the dotted line. The actual cost may vary depending on the size, location, design, existing condition of the property. That all needs to be taken into consideration. Local costs, permits may vary as well. Feasibility study is highly recommended before you start the process. It's really, really important that we go through that so that way we do know what's available for your lot size depending on your slope, and we all communicate together through that. What about insuring my ADU? So from the bank standpoint, we're going to want to make sure that everybody that you're working with is a licensed contractor, as well as the insurance that you're covering for the property needs to be adjusted because it now becomes rental unit. And should that building burn down, have subsidized rental income while it's being built. Make sense? So let me clarify. So you're going from a single family residence to a 2-unit property. That second unit is now become a rental. If that unit were to burn down for some reason, you are now losing out on rental income. You also need to house that tenant. The proper insurance coverage will have you house that tenant as well as subsidize the rental income you were losing while you rebuild. Make sense? So this is just a requirement that the bank has. It does change your homeowner's insurance policy a little bit. What else? Back up a little bit. Do it back up. Okay, there we go. All right. So, anything else you want to cover?
Yeah, if I can just
go for it.
Super quick. Yeah, Anthony does a great job covering all the different ways that you can pay for this, and I so appreciate that. And just a couple of comments on recommendations for whatever they're worth is work with a company that has some proficiencies with renovation lending if you're going to do a renovation loan. Make sure you work with contractors that are familiar with that process. That's super important too. Make sure you plan out your reserves up front. A lot of times we're seeing people get stuck and they just haven't planned all the way through, and that's where the renovation lending becomes so important because you can leverage more. And Anthony's made this point before, and it's really important. And some people are getting stuck in the middle, either on a cash out, they don't pull enough out, they don't plan for their own contingencies, so they do a home equity line of credit, and then they just can't get to the other side because they haven't planned on how to pay off the credit line to get to the renovation loan. So it's super, super important to pay attention to that. I would talk to the appraisers over here about market acceptance and market value because what it shows on paper right now might not be what it's really worth, and that's important to kind of take that into account as well. So lots of good stuff. Spend more time coming over to talk to us if you have other questions. And that's it.
Oh, awesome. What else on the renovation process? One of the beautiful things about doing this in advance is that we get to break down and work through all parties together. So one of the best things, best action steps I can recommend to you from the banking side is we get your architect, your builder, feasibility, all of us at the table at the same time, understanding what your scope of work is. And what I like to do, and I think he would agree, is we usually work the process in reverse. We'll figure out exactly how much you can pull out in terms of qualifications. If you can pull out 150, 200,000, whatever the dollar amount is, and from there we work your budget in reverse to make sure you have enough money available. You got 200,000, take 10% off of that, use some soft costs, whatever's left over. Contractor, I have 150 grand for you to spend to go ahead and do your build. What can you do? Everyone's there on the same table. You clear? The other aspect is from the bank side, and this is another benefit, is that we're going to collect all documentation from all parties in advance, including their licensing, their bond, their identification, their W-9 forms, all these particular things that typical homeowners don't ask for, and you really, really should. Okay? So that's pretty much it.